Hello, today we're going to discuss Chapter 10, Accounting for Revenue from Oil and Gas Sales. A couple of measurements that we need to keep in mind. Oil is going to be measured in barrels. 1 barrel equals 42 US gallons. And the document that typically is used to measure the oil is a run ticket. It measures the change in the volume to determine the quantity sold. Gas is going to be measured in MCF, 1,000 cubic feet. Now we have a document that's a division order, and this will tell us how the revenue from the sale of oil and gas is going to be divided between the different interest owners. It's a legal document, and it sets each interest owner's share of production. It's going to discuss the revenue, how it's going to be divided, and the operating costs, and it will note that those are only going to be the working interest owners. For example, revenue and cost allocation on page 367. Mr. Z owns the mineral rights in some land in Texas. He leases this land to Tyler Company, reserving a 1/8 royalty. Each owner's share of the first year's gross production of 40,000 barrels is as follows. So for the revenue, Mr. Z has a royalty interest of 1/8. The remainder, 7/8, is Tyler's. Tyler is the working interest owner, so he's going to pay 100% of the costs. Assume that on January 1st of year 2, Tyler Company assigned to Intex Company a 1/5 overriding royalty interest, and that production in year 2 was 80,000 barrels. Note that an interest created out of the working interest is stated in terms of that working interest owner's revenue share at the time the interest was created. Consequently, the overriding royalty interest share of revenue is 1/5 times 7/8. So as you can see, Mr. Z still has his 1/8 royalty interest, but now Tyler has split his interest. He's going to have a 4/5 working interest and 1/5 overriding royalty interest to Intex. Tyler is still the working interest owner and pays 100% of the costs. Assume that on January 1st of year 3, Tyler Company assigned to Joint Company a working interest of 25%, and that the production is again 80,000 barrels. So as you can see, following down for Tyler, he had 4/5 of the working interest, so you would have 4/5 times the 7/8, and now he has 75% of that, and he has assigned a 25% joint interest to Joint. On the cost side, Tyler has 75% of the cost that he will bear, and 25% will be paid by Joint. So if we wanted to multiply the percentages to determine a decimal amount, which is usually what you will see in a division order, Mr. Z has the 1/8 royalty, so that's equal to 0.125. The overriding royalty interest is 7/8 times 1/5. That equals 0.175. Joint has 7/8 times 4/5 times 0.25, 0.175. And Tyler has 7/8 times 4/5 times 0.75. Tyler has 0.525 of the revenue. As you can see, they add up to 100%, and you can multiply them and work up or down the tree from the different percentages. So for example, on Tyler's 7/8 times 4/5 times 75%. Discussing oil revenue, its responsibility of actually remitting the severance tax may be different depending on how the documents are set up. The purchaser of the product may deduct the taxes and pay the working interest owner and the royalty interest net of tax. In that case, the purchaser would be remitting the severance tax. Or you can have the working interest pay the amount. They may receive all the revenue and remit the severance tax and then pay the royalty interest owner. So first, on this example, we're going to determine each interest share of revenue and the tax. So Tyler Company owns 100% of the working interest in the Gilbert lease in Texas. Gilbert Jones owns a 1/8 royalty interest in the lease. During February, 4,000 gross barrels of oil, after correction for temperature, gravity, and the sediment, were produced and sold. Assume the price for oil is $64 a barrel and the production tax in Texas is 5%. So we see under the revenue interest our two interest parties. 7/8 is the working interest, which is Tyler, and 1/8 is the royalty interest. We're going to multiply that times the gross production times the price. So this is going to be their gross revenue in dollars. We're going to calculate the severance tax, multiplying the revenue times the tax amount of 5%. And then we're going to subtract them to determine the net amount of the severance, net amount of the revenue, net of the severance tax. In this example, the purchaser assumes the responsibility of distributing severance taxes and royalty income. So this is the journal entry that Tyler would make. Remember, Tyler's the working interest, to record the receivable net of the severance taxes. So we have our oil sales. This is going to be the credit, the amount of the gross revenue times the price times Tyler's percent of $224,000. We calculated the production tax expense, severance tax, in the previous slide, and the net amount is the amount that Tyler's going to set up for the receivable. Again, from the previous slide. Alternatively, if Tyler Company assumes the responsibility and receives 100% of the proceeds, he's still going to have the same amount of oil sales calculated and recorded as a credit. He's going to have the royalty payable. So since he's assuming that responsibility, he's going to owe and pay the royalty interest owner. And the production taxes includes his percent as well as the royalty interest percent. He's going to debit the production tax expense for the amount of his production or severance tax. And he's going to set up the receivable to include the amount that he's going to receive. Again, including the severance tax amounts that he is later going to submit. The royalty interest owner's entry under B or C, they're going to set up accounts receivable for the amount of the revenue times the price times their percent, less the severance tax. They're going to record the amount of the severance tax, and again, you can see these amounts on the previous slide. And going to record the oil sales, the gross revenue times the price times the 1/8 royalty interest. There may be a portion of the oil or gas that's produced on a lease that is actually used on that lease for fuel, for generators, boilers, pumps, etc. You may have a free fuel clause that states the royalty interest owners are typically not paid for the royalty on this portion of the oil or gas. It may also be transferred from one lease to another. So one lease would record revenue, and the other lease that's actually using the oil or gas is going to record the operating expense. So let's look at an example. Tyler Company operates leases A and B. The company uses 10 barrels of oil obtained from lease A as fuel on lease B. Assume the oil is priced on both leases at $80 a barrel, that production taxes are 5%, and that the royalty interest on lease A is a 1/8 royalty. So again, the important part is it's going to be 10 barrels that's going to be used for fuel. So we're going to calculate the percentages on that 10 barrels. So for the working interest owners, 7/8, so it's going to be 10 barrels times the $80, or $700, less the severance tax of $35. So the net revenue is $665 for the working interest owner. For the royalty interest owner, it's going to be his percent of the 10 barrels times the 80, so that's $100 less the $5 severance tax. So the net revenue is $95. So this is the journal entry to record the transfer of 10 barrels of oil. So you can see the first debit, lease operating expense, is going to be recorded on lease B, the one that's using the fuel. So it's going to be the number of barrels times the selling price, equaling $800, and then going to record the associated production tax, $35. On A's books, so this is going to be set up as a payable in the oil sales for lease A. You're going to have the oil sales of $700, the royalty payable of $95, the net amount, and the production tax payable of $40, the entire amount. You may also have a gas transfer, the transfer of gas between leases. It may be used for lease operation, gas injection, or gas lift to maintain the pressure in the well. It's going to be recorded as a lease operating expense for the value of the gas, and then as it's recovered and sold, it is placed back into the well. So the first journal entry is to record the use and the sale. So you're going to debit the lease operating expense and production tax expense, and you would credit production tax payable, royalty payable, and the gas sales. Later, when the gas is recovered and sold, you're going to reduce your lease operating expense with a credit and set up the receivable to be received from the purchaser. Revenue from oil sales is typically recognized when the oil is produced, or it can be recognized when it is sold. So to look at an example of oil revenue recognized at the time of sale. Tyler Company produces 3,000 barrels in the month of October. The sales price is $77. Assume the purchaser of the oil will pay the royalty owner and severance taxes. Assume that Tyler owns 100% of the working interest. There is a 1/8 royalty interest, and the state severance tax is 8%. So he's going to set up the receivable from the purchaser. He's going to record the production tax expense, and he's going to record the oil sales, the number of barrels times the price times the percentage. Or if the oil revenue is recognized at the time of production. So we're going to use the same data that we had in the previous slide, and the entry to record the production and sale of the oil would be as follows. Entry at the time of production, it would be put into an inventory account, crude oil inventory. This is the amount of barrels times the price times the percent, and credit oil sales. When the production is later sold in November, the entry is going to be to set up the receivable from the purchaser, to record the production tax expense, and to remove it with a credit out of inventory. And this concludes Chapter 10.